this is Aksha Menon from PMS Bazaar, welcoming you all for an exclusive interview with Credent AIM. The current market scenario is marked by volatility, uncertainty, and by global economic factors and geopolitical events to continue to influence investment decisions and reshape business strategies. Investors navigate a dynamic landscape seeking stability amid shifting tides. So, of course, there's a lot of confusion for the investors right now because of the volatility and uncertainty which is happening around the market. To have more clarity on it, we have Mr. Naysar Shah onto the show. Mr. Naysar Shah is a fund manager with 22 years plus of experience in equity research and fund management. He has managed funds at Brilla Sun Life for 4 years with AUM of around 2,500 crores, approximately. He has tracked a large number of companies across sectors and market caps. So, with no delay, let me ask the very first question to you, sir. In this world with increasing popularity of passive investing, you could see the markets are all-time high now. What are the advantages do you see to have an active multi-cap strategy offering for the investors?
Uh, uh, Thanks for the show. So we believe in India, the diversity of companies that we have, we have wide number of sectors, which represent the market and the companies that represent the market. We have, with diversity of companies across sectors in the market cap. And India is in a growth phase where we have multi years of growth ahead of us, and so we believe India will still be an active stock pickers market, while we have seen trend towards passive investing in developed markets. But given the economic cycle or the growth state that we are in as a country, we think we'll be still active stock pickers market for many more years to come.
With that, can you just explain overall your investment philosophy and approach when managing a multi-cap fund?
Yeah, so basically, we follow a blend of top-down and bottom-up approach. Top-down in the sense the industries, where the outlook or is positive or negative, or basically headwinds or tailwinds, or the sectors which are likely to do well in the medium to long term. And within those sectors, the companies which are likely to do well, based on the growth prospects that it offers, and all that, right? So basically, blend of top-down and bottom-up sectors, companies, and then while studying companies, you look at the growth prospects of the company, the management, capital allocation, free cash flow, return on ratios, all those things, and the valuation as well, right? So what you are maybe discovered, or maybe what you're studying, is it already in the price, with a three to with a let's say maybe 3 to 4 kind of view, whether the growth prospects are already being priced in, or there's a disconnect between price and value, right? So we would always want to stick a disconnect, between price and value, where we are getting more than what price we are paying, right? So that is an active investing approach that we take.
Yeah, as a continuing question that I want to ask is that with current market scenario, we're being very volatile and all, and the events of underperformance or change in the market conditions. What is the approach in managing potential, exiting your positions? How do you manage your exit strategy in this?
So basically, we just started in March, so it's been about 10 months. So we do not have that in terms of long history in terms of exiting the stocks, and so, but based on whatever little history that we have. So on the exit side, Indian markets go through phases of despair in the sense, and euphoria. We have seen sentiment was very weak. Stocks were available at throwaway valuations in March, and then we have seen sentiments being very good in recent times. So stocks have recovered smartly from those lows, right? So markets go on extremes on both the sides, greed and fear. So on the exit side, whenever we think that our thesis has gone wrong, or on the assumptions on which we have made investment, uh, that gets challenged, or we see that we were wrong in that assumption. It's not coming out, so we accept mistakes and then we exit. Second is, whenever we see there is a euphoria in a particular stock, or market is being pricing in more than what we think will happen over the next 2 3 years, and valuations have no room for upside, with a 3 year view, then that is the time when we would want to take money off the table. And third, whenever we see a relatively better opportunity. If something comes up which we think will do better than the one that we already own in the portfolio, that is the time you do a relative, switch. So basically, these are the circumstances under which we sell or exit a stock.
So who's your ideal investor for the strategy?
Yeah, ideal investor is somebody who wants to participate in India's growth story with a 3 to 5 year view. And we have a multi-cap strategy. So basically, we invest large cap, mid cap, small cap based on the merit of the individual stock, right? So with an absolute good return expectation with a 3 to 5 year, based on the growth prospect of the company that we invest in, at the same time valuations at which we enter. Somebody who wants to create wealth or generate alpha with a 3 to 5 year, with a diverse set of stocks and sectors that we own. He's an ideal investor for our strategy.
Yeah, with your all your answers, I got to understand that you are very bullish on India growth story. So, with saying that, what are the sectors do you think would drive the India's growth story for in next few years? What are sectors are you bullish on?
So, we are bullish on sectors like banks, mainly auto components, then, uh, discretionary consumption sectors, select IT, select pharma. So as I said, India has a very diverse set of sectors. So you would always have companies within a sector which could be growing faster than the industry, and companies which could be laggards. So our job is to find companies which are likely to do well in the medium term, grow faster than the industry, along with maintaining the balance sheet discipline, cash flow, return ratios, and all those things. So we actively look out for such ideas where we think market is not adequately priced in the growth prospects, and there's a scope for valuation to expand. So we find companies across sectors, but in general, you can say, banking sector, auto component sectors, select manufacturing, discretionary consumption, IT. So these are the stocks. These are the sectors which have a representation in our portfolio. But these are broadly the sectors. So within that, obviously, you have to do a lot of work in terms of, why a particular stock over some other stocks. Uh, so that calls for a lot of detailed analysis.
Yeah, well, your AIM strategy is a multi-cap strategy, and it is relatively new to this industry, which is just completed 6 months, and still it has given good alpha. So, how do you rate the success ratio there?
So, we started our strategy in March, and of course, March valuations were very favorable. So, we made a very diversified portfolio having, a representation of large cap, mid cap, and small cap. And, companies have delivered good numbers after that, and valuations were very low in March. And now, because it's been a very broad-based rally in that sense, stocks across sectors and segments have done well. And we have also done well along with that. So our thesis has mostly played out. Companies have reported good numbers, and now markets have kind of taken notice of that, and stocks have got adequately rewarded for the performance that the companies have delivered.
Yeah, but when you talk about portfolio diversification, so yours is the aim is a multi-cap strategy. So where do you sit in cash? How do you much you sit in large cap? How much you sit in small and mid cap? How is your allocation?
So we do not take very large cash calls. So we have roughly about, let's say, 20-25% large cap, roughly about 30% kind of mid cap, and balance, let's say, maybe 35-40% kind of small cap. So 20, I mean, I said 20-25% large cap, which are very large market cap stocks, and then balance spread between mid and small cap, and very little cash that we have in the portfolio. But obviously, portfolio is very skewed towards mid and small cap versus large cap.
Okay. So how do you see the mid and small cap valuations moving in this current market scenario?
So of course, YTD, if you look at the performance, small cap and mid cap has done better than Nifty.
Hmm.
And now, of course, on a 5 year period, also they've done better than the market. And if you look at last 10 years as well, the CAGR of small cap index is better than the large cap. The only thing is it comes with this associated volatility, because they go through the times of despair, euphoria, and they go on both the extremes, right? But So they have, these stocks exhibit very large volatility. But more than the small cap, basically what you do see is the underlying companies that you are investing in, right? The business of the company, the management running the business, and the balance sheet, cash flow, and the valuations, those parameters, right? So if it's a good company, if it's a large cap, mid cap, small cap, it's just that based on the segments that we define as a small cap. But if it's a company which has good characteristics in terms of business qualities and all that, so it really doesn't matter whether it's a small cap. And if you see a lot of sectors in India still, even the leader in those sectors, some of these sectors, they do not have company from a large cap, right? The largest company in that small sector could still be a small cap and not a large cap company, right? So our job is to find good companies and not worry too much about whether that company belongs to mid cap segment or a small cap segment. As long as it meets our criteria, then we invest in that stock, even if it's a small cap, mid cap, and all that. So basically, it's just based on merit, on the company. So the parameters of the filters that you apply remain same. Of course, in small cap or the mid cap, if the management doesn't is not proven, then obviously you need to do more thorough work in terms of corporate governance, management, and all that. But once you are satisfied with that, and if it offers higher growth prospects, then over a medium to long term, it would create good wealth. If we are right in our thesis. So basically, just treat company based on the business quality, management, balance sheet, valuation, and all those parameters, and then make a diversified portfolio. Uh, right. So even if few bets do not work out well, you do well at an aggregate portfolio level. That is the approach that we have.
Okay, so when you talk about volatility and portfolio diversification, so how often does current AMC rebalance the portfolio? Like, for example, I'm taking AIM strategy, which was just completed 6 months and still has given good alpha. So, how often do you rebalance this portfolio?
No, no. We don't do that rebalancing on a regular basis. So let's say we have taken we have taken position in a stock and based on some allocation. So so whatever happens in natural course, the if stocks does well better than other stocks, then naturally the allocation of that stock in a portfolio will go up, right? But we don't do that active balancing. So once the portfolio is constructed, we have the stocks that we want in our portfolio. Portfolio is made, then we do not tinker around with the portfolio on a regular basis just to adjust the weights or allocation. We leave it like that, and it will follow its natural progression in terms of the stock does well, weight will go up, and vice versa. And if 1 week or 1 month particular stock does well, weight goes up. In next month, some other stocks will go up. Automatically the weight of a previous stock that will come down if it's not done well. So it balances out in the natural course. So we don't do uh, you know active tinkering in that just to adjust the allocation or the
Yeah, when you
sizing.
talk about that, about the weight of the stock in a portfolio, of course, the market is very volatile. And do you have any predefined strategy to protect your portfolio from this, uncertainty in the market?
So in our portfolio, no single stock accounts for more than 10% of the portfolio. Okay, and we have exposure to diverse sectors in terms of we have very good representation across sectors, and then we have a diversified portfolio as well. And in smaller names, we do not take very disproportionate allocation. So we just adjust our sizing and all that across segments, diversified portfolio, and adjust it in our portfolio allocation or the sizing rather than and we, of course, when we buy the stock, we look for very high margin of safety in small cap names, right? So still stocks can still exhibit a lot of volatility, but we know that we have identified the right business. We need to give management time to execute that, and we know that valuations are in our favor, or we had enough margin of safety while buying the stock. Then, of course, then we have to see how company does well in, let's say, next 2 to 3 years, and if we are right in our assessment, market will reward us accordingly. So basically, no large concentration in a particular name, good diversification across sectors rather than taking very sector concentrated exposure, and then balance approach between various names. So that's how we spread out our allocations or holdings, and then let's see how it does.
When you say right business or right management, like how do you quantify it? Because it will be useful for our investors who's listening to this.
Yeah, so basically, you have to understand the industry or the sector that business represents as to, what are the growth prospects of that sector, what is the positioning of the company within that sector, and whether that sector, most of the sectors in India are cyclical in nature. So where are we in the cycle? And what are the growth prospects of the company or the sector over the next few years? And the management, the past track record, how they have done in the past, and whether you trust the management or whether the management is good, capital allocation history, that you check all those parameters, and then you see the balance sheet, cash flow, return ratios, and all those things, and then if everything is good, whether market is already pricing in what you are discussing, right? Or is there a disconnect between the price that at which it is quoting and the value that you get based on your assessment? So if there is a disconnect between price and the value, then you know that if you are right in your assessment, medium term market would take cognizance of that, and accordingly, you would get rewarded for your analysis and the patience in the medium term.
Yeah, that's very true. And one
But
more
of
thing.
course, it comes with experience. It's a long run process, to assess all those things. So, yeah.
Yeah, of course. When you talk about experience, that's very true. And one more thing is that you've seen different market cycles, and the huge sort of HNI clients. The new gen HNI clients who's just entering the market. How do you see the risk tolerance from them? The new Gen Z HNI.
So, it's very individual, right? Of course, we have seen post-COVID the rise in the number of demat accounts, or the active client base or SIPs. We've seen massive increase in all these parameters post-COVID in last, 3.5 years, right? And of course, people are discovering a lot of ideas in small cap space. So to that extent, discovery could be relatively faster compared to the time it used to take in the past. But there will still be greed and fear, right? Those things would always be there. When you see markets like this, people would have the FOMO, right? That markets are going up and they're not adequately participated, and you will have that. And when you see times like, let's say, March 2020 COVID type, you will have the fear factor in your mind. So those greed and fear factors would always be there. So whether it's Gen Z or maybe, let's say, well, of
Oh,
course, if you're not seeing the cycle, it will likely have more impact than somebody who has seen the cycle, so they know how to handle such phases. But obviously, that comes over a period with experience.
yeah, very true. So, with that, we have come to the last question for this session, and that question would be like, what do you want to say to the clients or the investors who are willing to invest in this current market scenario? What is your saying to them?
Of course, clients will have to first do the asset allocation at their end, based on the uh, based on the income profile, the expenditure and the stage of the life cycle they are in. First, they'll have to do the asset allocation, and then once you decide that this much money you have to put in, let's say, in equities, then the multi-cap strategy, because that will give exposure to all segments of the market based on the merit of the company or the sector. And then you give sufficient time, before you see the benefits of that. So you come with not less than 3 year view, and then you in the intermediate period you will see very high periods of volatility. But once if you've done your asset allocation right, ideally that should not affect your that should not bother you too much. And then once you understand all those things, and then maybe you'll see good returns in the medium term, and then equities will compound, will do a good job over medium to long term. But you have to give minimum 3 years for equity, because you could have 3 years which are very bad, and then suddenly 3 years market not doing well, and suddenly fourth year market doing very well and maybe giving you good CAGR. So equity returns are never linear, unlike other some of these other asset classes, right? So to that extent, you have to accept that, give some time, and then let it compound over a longer period.
Okay, with that, it was very informative one, sir. Very informative session to our investors. Thank you for that, sir.
Thank you very
Yeah.
much.